Home Depot and Lowe's, the two biggest DIY home improvement places, announced earnings. Let's look at it right now. So guys, here's Home Depot's last week. They announced their earnings. Biggest things. An increase of 3.8% in the first quarter for sales to $1.4 billion for Home Depot. Comparable sales for the first quarter increased 2.2%. Comparable sales, if you watch other videos of ours, comparable sales, look at the store sales on stores that have been open over a year. Because remember, a company can increase locations very easily to drive up revenue. But we want to see that the stores they have opened were open smart and they're still driving revenue. A couple other things. Net earnings were $4.09 per share compared with $3.86 last year's same quarter. So an increase there. Good stuff. They also raised their fiscal guidance. This is a big thing for companies. Companies might come out with good earnings, but if they don't sit there and talk positive about the future, they can get hit pretty hard. They raised their guidance. They think that total sales growth and comparable sales growth will be around 3%. Okay, not bad. Now, let's look at Lowe's actual press release to see how it differs. Consolidated comparable sales decreased 4%. Guys, that is not good. They blame the weather. They're saying that now spring is here. They're seeing much better increase in foot traffic and sales in the stores. Home Depot did not have that issue. They reported net earnings of $2.3 billion and diluted shares a profit of $3.51 compared to $3.21 the previous year. So even though sales went down, they still reported higher earnings per share. For total sales decrease, like I said, 4% here. But during the quarter, the company repurchased 19 million shares for $4.1 billion. And it paid $537 million in dividends. Okay? These are some of the things that these companies talk about. The first couple pages of a press release are a great way to get information. So let's use our software now to go analyze the companies. And if you wait just a little bit, we'll tell you what we should pay for the company based on the future and some assumptions we're making. 8 pillars. I'm going to do Home Depot. So some high levels on Home. Whoa, look at this chart, guys. A high of 420. Probably hit a few times. For those of you guys who are chartists, who look at charts, that was a definite resistance point. And the company is currently selling for $285, which is pretty much at its lows. $279 in the last year at some point. Dividend. So guys, here's the thing about the dividend. Dividends aren't always safe. You want to make sure the company can easily support their dividend payments. Home Depot paid $7.2 billion in dividends out of their $11.3 last year and the $12.25 average. That's well over half of their profit going in, their cash flow going in dividends. Is that good or bad? Well, I would be apprehensive about that. I'm not saying it's going away. That's a big chunk of their cash flow to going out to dividends. So just keep that in mind. But look at this high return on invested capital of 27%. Let's just go right to their 8-pillar tab. And look at this, guys. If you've watched our videos before and have our software, you see this very common occurrence. The valuation metrics, 5-year PE and 5-year price to free cash flow are both X's. The rest are check marks. Buying back shares, reasonable debt, cash flow growth, net income growth, revenue growth, high return on invested capital. So this just tells me that I want to own Home Depot probably, but I just got to pay the right price for it. Okay. So what's the right price? Well, that's why we have a stock analyzer tool. Guys, our goal here is to look at the future and determine what we want to pay based on assumptions. But how do we know the future? Well, one way of getting some guidance is some people like to see analysts' expectations. Now, keep in mind, guys, they're making guesses just like you and me, but it's a nice way to sit there and see where things are. So let's first go to Home Depot and look at their earnings per share. These earnings per share growth, it's about 5 or 6% a year for the next 7 or 8 years. Guys, the further and further out they go, the less reliable they are, but at least it gives you some idea of where the company will be. Because a lot of people will sit there and say, oh, Home Depot is the best. They're going to quadruple in size. They're going to grow like crazy. Well, not really. What about their revenue? Let's look at their revenue assumptions. Very low. 3% roughly over the next 7, 8, 9, 10 years. Again, these are estimates, but it makes sense. This is a very, very large company. You should expect them to grow with about inflation or a little bit better than that. All right. So if we have a lot of inflation, this will probably go up higher, but we can use these as a guide for our assumptions in the stock analyzer tool. So let's go right to it right now. Hit the stock analyzer tool. Remember, guys, we always do a 10-year I always do a 10-year analysis. You can do 1 to 20. I choose 10. So revenue growth numbers. Now, see, they did 8% revenue growth over the last 10 years. They opened a lot of stores, I'm sure. There are things like that going on. I'm going to be much more conservative. I'm going to go in the analyst expectation level and probably do 1, 3, and 5%. Profit margin, very consistent profit margin. 9, 9.5, and 10. Free cash flow margin, guys, I'm going to mimic it because look, it's basically there already. And for PE and price to free cash flow, I'm going to do 13, 15, and 17. And then for my returns, I want 12.5%. It gives me a reasonable margin of safety and gives me a reason to buy the stock versus investing in an ETF. I hit the analyze button. Remember, guys, the stock's at 285 right now. Okay, we still got a ways to go. Now, you might sit there and say, wait a second, Paul, 176, that would make the PE like 10 or 11 or whatever the number is. Well, guys, it's not a fast-growing company. For a high PE, I think you need a really, really good moat, which I think you can make the argument that Home Depot has, because it'd be very difficult to replace Home Depot. And 2, you need a lot of growth. They don't have that here. They're too big to have a lot of growth. So we have a low range of 135, high of 230, and somewhere in the middle of 176. This is just a guiding force. Now, these numbers can all be altered. If you alter their growth to 3, 5, and 7%, it changes things to almost being a buy today on the high side. But you know me, guys, if you watched our videos before, I like to be conservative. And I'm going to do 1, 3, and 5. And I'm just going to wait. So I'm going to sit there and hit 176. I'm going to add it to my watch list. Doesn't mean I'm buying it at 176. It means let me go reevaluate the company and see if it still makes sense at that price. If it does, through my other research, I will buy some. But I'll notify me, and I'll let myself know at that point to do more research. Let's go check out Lowe's, guys. So we go back to our main screen, hit the 8 pillars. Type in Lowe's, and here we are. So guys, here we are in Lowe's. Look at this chart, very similar to Home Depot. You got a high here of 263, and now we're trading near the lows of 170, 175. We're at 183 right now. A couple of things to point out here. Much smaller dividend yield, but also 1.7% versus much higher with Home Depot. I think it was 4, but also much lower dividends paid as a percentage of the 5-year free cash flow. So it's way less than 50% versus Home Depot's was 60 or 70%. Okay. Another thing I want to show you guys. Look at the profit margin last year, 8.9% versus a 5-year average of 6.4. What this shows to me is last year was just a stellar year. And we shouldn't extrapolate out this PE of 14 for the future. I'm more focused on this 5-year PE. If a company has a really, really good year or a really, really bad year, for some fluke reason, don't give them credit. Don't hurt them or give them credit for that reason unless there's a real, true fundamental shift. Okay, so let's go to the 8 pillars tab. So guys, in the 8 pillars, wow, look at this. They've bought back 23% of their shares, almost a quarter of their shares in the last 5 years. So their 5-year PE is 23.18. Their 5-year free cash flow is 21. A little more debt than as a percentage of, as a multiple of free cash flow than Home Depot. So the question is, what do we think of this? So this is another example. Even with 21 being a check mark, what's the growth potential for Lowe's? I imagine their growth potential might be a little bit better than Home Depot's, maybe, but it's probably going to be pretty much in line. So again, let's use a stock analyzer tool and figure out what we want to pay based on this guidance. But let's go look at those analyst estimates first. Look at these numbers. Much higher growth potential than Home Depot, if you remember. Home Depot was stuck in that 6, 7, 8% range. Much bigger for Lowe's. Revenue growth numbers, about the same. Start off a little bit worse, but pretty much end up the same. They make more money. Let me check out one thing there, actually, guys. Let me look at their Home Depot, their profit margin. Oh, wow. Their profit margin at Home Depot is much greater than Lowe's. Much greater profit margin at Home Depot than Lowe's. That's interesting. I would have thought they'd be pretty similar, but they're quite different. So something to keep in mind. Again, so let's go to the stock analyzer tool and figure things out. So I'm going to do 2, 4, and 6% revenue growth, higher than I did for Home Depot. I'm going to do 5.5, 6, and 6.5% profit margin. I'm going to do 6.75, 7, and 7.25. PE, same PE. Even though it has a slightly better growth potential, I'm still going to hold off for the same 13, 15, 17 because it's still a large company. And here are the estimates. A low of 85 to 105, a high of 155 to 175, and in the middle, around 116 to 136. So it's saying that we have a ways to go on everything. Understood. What I'm going to do, I like to go off the middle number, probably hit up the highest number. I'm going to hit notify me when it hits below that. Okay, great. Now I know this is my place to start for Target and Walmart. Thanks very much, everyone.